There it is. And we're live too. On my way. Not alone.
You guys want to send that out on your social media? That's the link to the live stream.
It's funny. I didn't even know we were doing it live. That's awesome.
Yeah.
Yes.
Makes it interesting.
I will send it right now, actually.
All right, a little Led Zeppelin to get us started.
Yeah.
All right, George, Chandra. So glad you guys made time for me today.
Well, thank you for making time.
Thank you for having us, Chris.
Yeah, this is pretty fun.
I reached out to George and blackmailed him into doing this in order for me to give him a pump up on Product Hunt. And I wanted to learn more about what you guys are doing with Founder Pool. So I think I'm going to let you go first, Chandra, because I want to hear your story about Founder Pool. I find it super interesting.
Cool. So Founder Pool came out of thinking systematically about startups and startup risk for founders. Started out with a blog post I was writing about towards the end of last year, mostly introspection about like what's going on with startups right now, how does the landscape look for founders, what are the career uncertainties that founders face, as well as how do we do this startup as a career thing better than it has been done before. In the sense that if you think about a startup as a 5-year commitment, right? You have an idea, you build a product, you get some customers, and then it becomes a business with very, very high odds of failure. But your opportunity cost, the commitment and the effort and the money that you put into it is huge. And you also, when you consider the fact that most people do this at the prime of their career, right? They could be doing anything else. Most people are at the peak of their energy, their focus, their risk tolerance, and it's even more of an opportunity cost to do a startup. At the end of which, more than 90% of the time, maybe even 95% of the time, you are going to end up with nothing or nothing to show for it. So how do you systematically de-risk that process? Because we all agree we need more entrepreneurs, we need more builders, we need more makers, we need more innovation in the ecosystem. We don't want to be beholden to like 3 big companies that rule the internet.
I have a question for you. Are you actually off of a cliff doing this podcast by the Golden Gate Bridge?
I wish I was. I'm actually at home using a virtual background because the air outside looks pretty terrible and not like what you're seeing back there.
Yeah, I've seen a bunch of warnings today in Vegas about all the wind blowing up the desert sand.
Yeah.
Where are you at,
It's very smoky. I'm in the East Bay right now.
Like actually in the East Bay, you're like on maybe like a little kayak and stuff?
No. I'm actually in the East Bay, unfortunately. Not on the bay, but yeah.
So George, how'd you get involved in this?
Well, just to let you know where I am, I'm in Maui, right? So I'm in a little bit above better situation. Now, how did I get
the best of it all?
Just a tiny bit. Just
how
a
did
tiny bit.
I get into this? Well, so what's funny is you can take a look at someone's path in life and look at all the things that they've done leading up to today. And only when I look back on my life do I realize this path toward Founder Pool makes a lot of sense. And I'll tell you what I did. I had just recently updated my profile on Product Hunt because we're launching on Product Hunt tomorrow. To say I can only fit a few characters in my profile header. So I put 3 exits, 100 flops.
Yeah, I like
it. Right. And so
right.
I don't, most founders, I can't say every, most founders feel that. They might not be brave enough to admit it, but they do feel that. Most successful companies are a series of pivots, even if it was just their first company that ended up being successful. It never really turns out to be what the founder initially set it to be. So I've had some successful exits, not big ones, but any exit to me is successful, and that's excellent. But also a number of failures. And when we look at the companies that I've put together in the past, the ones that had exits versus the ones that didn't, well, on their way up, they looked very similar. It was very difficult to tell the difference. So because we're entrepreneurs, we're overzealous, we're type A personalities, and so everything looks like a rocket ship to us. But we need to take a step back and have a bit of insurance. And so the best way that we think that you can have an insurance in your startup for yourself as an entrepreneur, not necessarily insurance for the startup, but insurance for yourself as an entrepreneur, is to pool that risk with other entrepreneurs. And this came about as the pandemic was crushing companies. Chandra, Manoj, and I took a deep look at what we've been trying to build over the past several years and realizing that this was a such better path to helping the world than what we were working on previously. So we ended up talking with a few friends, CEOs of startup companies, who said to us, yeah, they experienced the problem of being really worried about the future of their company, even though they'd raised several $1 million, tens of millions. They were certainly concerned.
Did you guys
So
raise
money?
money?
No, we're not raising money yet. No, we haven't needed to.
Wow, that's impressive.
I'm really blessed that we haven't needed to yet. Of course we will. I think that's going to be a huge path toward us being able to win it. Because this may be a winner take all game. I'm not sure.
Are you guys going to create a secondary market, kind of like what Barry Silver was doing during the Facebook days before they went public?
Well, before we talk about a secondary market, maybe we should talk a little bit about what Founder Pool actually is.
Okay.
Right. Chandra, why don't you take that?
Sure. So Founder Pool is basically a bunch of entrepreneurs putting the common stock that they own, a fraction of the common stock that they own, into a pool that is then owned by all of those founders. So instead of owning whatever the percentage of equity it is that your founder stock percentage is in just one startup, a portion of that equity is diversified by actually exchanging it for stock in many other companies. So at the end of 5 years, like I said, this is an oversimplification, of course. If your startup doesn't go anywhere, you're still going to have exposure to a lot of high quality startups. And if one of them makes it big, you're going to have returns that are going to mitigate the downside and the opportunity cost that you have as an entrepreneur.
So people pledge or give, or, I mean, how can they assign their equity in a privately held company into the pool?
Just like you transfer equity from into any other vehicle. You, as the holder of common stock, can transfer the equity that you vested to anyone with board approval. The alternative model is you pledge the proceeds from the equity. It's kind of like a futures contract. So there's two ways to do it.
So, okay, so is there a legal filing that has to be done? Do you have to file something with the SEC?
No, you just have to get your board approval, and the process is, the process.
I love this. I think this is, has anyone ever done this before?
Not as far as we know. People have talked about it very frequently. It has been discussed by some folks in the area and I've also heard that every batch at Y Combinator and other startups actually keep discussing this, but they don't do it because it's a hairy thing. It's not an easy thing to do. But when we started talking to entrepreneurs and CEOs and founders of other companies, we realized that everyone instantly understands this problem. It is still hairy. There's lots of issues where how do you know the quality of the companies coming in, all sorts of issues. But it is a hairy problem with a big need for it. So if you put the time and effort into solving this problem, it will help a lot of people.
So who's doing all the legal work? Is that you or George?
Luckily, neither of
no.
us. We have a
liar.
we have a well, yeah, that's right.
Yeah.
We also have a really fantastic guy who has been at Facebook for almost 13 years as the head of legal operations, and so he's part of our team.
Right. He is the liaison with the law firm, with our law firm. So he's in charge of the legal process and paperwork and all that stuff.
And Chris, you also asked about whether people have done this before. We don't think in an official capacity, but
as a product, no one has done it.
As a product, right? It's been done
as a product,
times
no one has done it.
By I even have a friend who had done a pool with a few of his startup buddies at his college, and his own startup died, but his friends went on to raise just 20 million recently. So they're doing pretty successfully. There's also a story I heard about the
100 million.
Say that again.
20 million, but probably at a valuation of, let's say 100 million, maybe.
Yeah, it could be that, right?
Likely,
so they're
close to that.
Even if he's only got 1% of that, he's got a percentage of $1 million.
Yeah, so we're targeting percentages that are about 5% of the entrepreneur's vested stock.
So 5% average entrepreneur probably has 20, 30. So you're getting like 1.5% of the overall company. Say 1%.
Right.
This is a great idea, guys. I think you're going to crush it. I literally think this is something. I'm shocked that Tim Ferriss or Jason Calacanis or some of even Y Combinator hasn't done this. In fact, I'm going to make a prediction. After you guys launch, they're all going to copy it.
Well, I didn't reach out to Tim Ferriss, but I did reach out to Jason over Twitter. He doesn't know who I am, but he also ignored my DM. So we'll see after your podcast whether he reaches out, because you and he are probably besties, right?
Well, we played poker together, and I have insulted him for playing like a nit. So I'm almost sure that he's watching this right now, and he'll probably copy you rather than call you back, because he's just that kind of guy. Now, Jason's a good guy. He's done a lot of good things. He plays absolutely terrible poker. He is literally the biggest nit at the table. I've seen him lay down trip tens on a jack high board. The funny thing is, at the river, it was a good fold, but he was way ahead on the flop. Shout out to Jason Calacanis. He does have a pretty damn good game. I'll give him that. He's got a home game that includes Chamath from Social Capital. Chamath is a gambler. That guy gambles. He has the money.
He has the money too. Why not?
He will make you sweat when he shoves. He's got zero fear, and he has serious gamble.
Well, that's something. A friend of mine was actually equating the model to side pots in poker. Now, I'm not a poker player.
That's right.
So
right, but
side pot. Yeah, I wouldn't call it that. I would call it a last longer bet. Are you guys familiar with last longer?
No, I see. I'm not much of a poker player. So what is the
So,
last longer bet?
so let's all say all three of us go into a poker tournament. We put in $1,000, and the payout for the poker tournament is, let's say, $500,000, winner take all. But we all three say, you know what? Let's put up 1,000 between the three of us, and whoever lasts the longest gets that money. So you may drop out at 190th. I may drop out at 180th, and Chandra might drop out at 170. He just made $3,000 for his $1,000 investment, or actually $2,000 investment, 1,000 into the tournament and 1,000 into the last longer bet. So he literally lost the tournament by getting knocked out, but he made money because he won the last longer bet. And usually the last longer bet, there's like 40 people. So it's actually a bigger payoff than $3,000.
That's fascinating.
So yeah.
So it's similar. The right analogy is if the three of us or 30 people are entering a tournament, putting in $1,000 each. If the odds of any one person winning are whatever, 10%, whatever, right? And then they pledge 10% of their proceeds to the rest of the group. So not only do you actually get back the money you put into playing that tournament, but you make a little bit more for the opportunity cost. So that's kind of the right analogy.
Yeah, well said. Well said.
Hey Chris, let me ask you something crazy. So in spreading out the YouTube URL for this live podcast, we have our business partner who's like, hey, come on, I wanted to be on this. Is there room for one more?
You share the link with him?
Yeah, I'll share the link with him. Sure.
Tell me.
We'll keep the conversation going till he arrives.
Tell him to ship me $20 in Bitcoin, and I'll actually let him in the room. This is almost like that new Silicon Valley app, Clubhouse. We've got a little Clubhouse going.
Clubhouse with better background, huh?
Probably. I mean, I think isn't Clubhouse like virtual or something?
No, it's
right.
It's audio.
Clubhouse,
it's audio.
Just audio. It's just audio. There is no video.
Yeah, audio only, and the people who are listening in can be brought on stage, so to speak, if they have questions, right? And then they can kind of become the talkers, right? So you kind of have a fluid set of panelists using Clubhouse.
Right.
So
who's actually pretty engaging.
Who's joining us?
So Manoj Dugarala is actually Chandra's brother, and he's also our CTO.
What's his name, Manoj?
That's right.
I'm pretty good with names, so I was pretty surprised that I got that one right out the gate. Chandra, what'd you do before this?
So I was doing another company with the same two guys, and it was called Fuel. And the idea was your nutrition should be personalized to you, and it shouldn't be personal. It shouldn't be a one-size-fits-all. So we built
vitamins.
No. It's actually meals. So we built the software that actually takes in and ingests your DNA sequence information, identifies all of these different biomarkers that are nutritionally relevant, identify your predilections for certain diseases or allergies to certain nutrients, etc. We would combine that data with your activity trackers, like whether you're using your Apple Watch or something else, and even your labs and biomarkers coming in from your doctor's office, for example. And we create a composite profile for each user as to what they should be eating, all the way from how many calories to macros and micronutrients to specific nutrients to target, all of that stuff. And it's all optimized in real time. For example, if you're losing weight versus if you're gaining weight, if you're not sleeping as well versus if you're sleeping well, it changes your nutritional recommendations in real time. So that was what we were working on before this.
Were you handling?
It's a great concept. We were shipping out meals across the country. We were bringing in 7 figures in annual recurring revenue, had gone to 500 startups, and yet the entire meal delivery space, according to venture capital, was dying because most of these other meal delivery services were having negative margins, and it was pretty it was a bad signal for us, even though we had profitable margins per meal. So unfortunately, we couldn't raise despite all that traction. Right. So this is one of those things that goes, okay, yeah, founder pool makes sense, right? We had everything going for us, but the entire space died. There was no money left for growth in meal delivery.
So that's one of those left field, black swan, far off the left field kind of a risk, right? Like you have traction, you have profitable margins, you're growing, your acquisition costs are coming down, but there's 5 other companies that have combined raised about like $250 million and blew it all on trying to acquire customers that are costing them money in the long run. So there's no positive, payback of acquisition costs. And so that killed the entire space, despite whatever we do.
Surprised. I'm an investor in a project called Potentia, and it's basically targeted vitamins for, to start your day, for energy, boost, the whole 9 yards. And they're basically in the little pill packs. You familiar with the pill packs?
Yeah.
Mm-hmm.
Yeah. Amazon paid a pretty penny for that company.
Yeah, I was gonna say they could have easily done it themselves. I'm shocked that they even bought.
It's distribution, right? They got the mind share. It's growth. They did well.
Yeah, but they didn't have that many customers. That's the crazy thing.
Is that right? I didn't know that.
Yeah, PillPack. I don't know the exact number, but they had very little customers compared to what Amazon paid for them.
Shocking. Maybe it was one VC washing the hands of another VC.
Dude, you know how many times that happens in Silicon Valley? They're always just bailing each other out of bad deals. So is your brother?
And now you won't have to.
Is your brother going to join us? Is he trying?
Oh, so he said now he feels embarrassed, and so I'm going to make him even more embarrassed by saying that he feels embarrassed. He said his kids are running around and it would be an awkward situation. So he said for me to keep him in the loop ahead of time. So that's my fault.
Oh, who cares? He gets to play with his kids. I get to play with you.
Yeah.
Two. All right.
But you were talking about your company, right? Before we go back to ours, the one you're investing in.
Potential.
Potential.
Yeah.
It's targeted vitamins. I don't know if you've ever started your day by taking out a bunch of these things and then pulling one pill out of each one and then taking it.
That's right. That's right.
It's basically
that's the idea of pill pack. Yeah.
Yeah, it's basically
pill pack for vitamins. Exactly.
Well, it's pill pack for vitamins, but it's not that it's your vitamins that are packed into a pill, because that was a very expensive model. What we did was we gave people a grouping of pills for whatever they wanted to do. So the first one we're launching is called Start, and it's a grouping of targeted vitamins to start your day with. CoQ10, everything but vitamin C. We found that vitamin C you get in all kinds of stuff, orange juice, basically everything has vitamin C in it.
Makes sense. Yeah. And you can't give someone enough vitamin C orally for it to make any difference in their immune system.
Exactly. So
I mean, you can if you were deficient, right? Or you'll get what is it, jaundice, right? Is that Chandra? Is that what you get from no, not jaundice. What are the early people on ships, right? From like the 1600s. What did they? Scurvy. Thank you.
I actually think nobody's gotten scurvy in this millennia. It's been a while since somebody got scurvy.
Yeah.
So you guys are launching Friday or tomorrow?
Tomorrow morning. Yeah.
What is tomorrow? Wednesday?
How many companies do you have in the pool?
We have 2 pools right now. One is early stage. I think it's 18 in the early stage and 6 or 7 in the late stage companies. These are post C, post B companies.
Dude, I think that's awesome. I mean, literally 18 in one, 6 in another. That just screams you're going to crush it. I'm telling you.
Thank you.
I wouldn't even say this. There's so many companies that have just a shitty idea or a shitty user acquisition plan. I think you guys are going to get run over by people that want to get involved. Now, where's your money made? Are you guys charging a management fee, an exit fee?
So we take a membership in every pool. So
It's as
our
simple as
interests are
that.
aligned with, yeah, it's as simple as that, really.
So what's your membership fee?
So let's say there are 20 companies, we take 1/20th of that pool, like one membership.
Okay, so you take yours in equity. But
Yeah,
how do you,
yeah,
how
yeah,
do you keep the lights on? How do you pay the bills? You gotta have other revenue.
Right. So of course we're going to be externally funded. There's two ways to think about this. One is as a fintech product with a platform fee, right? Two, we think of this more as a network. And when you think about 30 people or 20 people who have strong incentive alignment to actually see other people in the pool succeed, the kind of community that develops is very different from a loose community that you see, right?
I think that's part of the beauty of this. I mean, that's really a beautiful aspect of this. And here's the interesting thing is you might have 3 top executives from a startup all be part of the pool, correct?
That's right. That's right.
Other ones you
So
might
in
have
that case,
one.
Yep. And so in that case, what we do is we reduce the weighting, meaning the amount of equity they contribute, their membership contribution per person. So not any pool is overweighted by any one startup.
Guys, this is a great project. This is going to do really well.
I think there, if you had 3 executives from the same company want to join Founder Pool, I think it would behoove both the executives and the company to join 3 different pools, because you then get to spread the exposure to other companies, and also you wouldn't have to split your equity contribution in 3, so you can move the needle better for yourself.
That's right. Better diversification for yourself.
So what's your roadmap look like over the next 6 months?
So our goal is to actually get to so we've had 100 applicants so far. We haven't really done any acquisition. We've done most of this year, starting in May, we've spent on customer development and discovery. The next 6 months, we plan to actually make it 10x. So 1,000 companies, that's our goal.
I think you'll do it very quickly.
I hope so. I hope so. And the interesting thing is, but that is actually conditional on one thing. We want to make sure that the initial pools that are formed are very successful, meaning like the customers are really, really happy with the dynamics of the pool, the process of selecting the pool, all of that stuff.
So you're doing due diligence and vetting out everyone.
We do. So the process is when a company comes in, when they apply to us, they actually get screened by us, right? First part is we screen them.
You know, Chandra, George, one of the things that I think you guys should really look at doing also, and this is probably going to be a lot easier than dealing with securities, is you should do a pool of tokens for companies that are launching in the crypto space, and you could literally store those tokens you could actually receive those tokens and divvy them up as dividends or as positive earnings amongst all the pool members. I think that in the crypto space, this has a great application.
This is one of the primary uses of tokens, right? Like the waterfall, the flow through of all of the money and the proceeds from the token value or whatever the tokens represent is 100
partial ownership
more simple than actually partial ownership, splitting the proceeds. That is completely programmatically done compared to the legal stuff that you actually do in the meat space. You know what I mean? But that's definitely in one of the in the long-term roadmap. We have to look at the legality of doing that, and it may take some time to get to crypto and tokens.
The thing is, you've got a problem right now for equity entrepreneurs, where their path to liquidity is 4 years to 8 years to 10 years, if at all. A token entrepreneur has the ability to flip a switch. Well, actually, I don't want to make myself sound stupid, all right? Because you don't just flip a switch and now you have a token network. Yes, that's kind of how it works if you wanted to release an ERC-20. but that's not really what I mean. Essentially, a
Actually,
token network
exactly.
can, you can get
Once you have
liquidity.
you can sell that token on an exchange. So that's the beauty of it all.
If an exchange will carry you, yes, but you also have the ability to get it listed on something like Uniswap, very, very simply.
I was going to
Point
say,
is that, yeah, an entrepreneur's
Uniswap,
payday in crypto can happen very, very quickly, but not in equities.
yeah, no,
So that's why we're concentrating there.
guys, this has been super awesome. I'm going to leave a link underneath this video where people can find you both. And
Sure. Thank you. Appreciate that. Before we go, just one last thing that I wanted to harp on. You had asked a little bit about what our vetting process was. I think the beauty here is that we only put people through an initial vetting process as well as a due diligence process afterward. But what we don't do is actually select who goes in the pool. It is a pure selected process.
so everyone votes you in or out of the island?
In a ranking based system.
So the way it works is you get to select the top companies that you want to share equity with, right? And that's based off of all of the materials that the screen materials that we supply you. You can request an intro, you can request a one-on-one meeting, or you can do a group call. And then after that, you get to rank, and everybody ranks the top choice of their startups. And we use something called stable market matching algorithm to actually create the pool out of all of these cumulative rankings that everyone submits.
And that's awesome. I think that's really good.
We think that's a way to reduce adverse selection that can make it into the pool. You'll certainly have some adverse adverse applicants, but they won't make it into the top because as an entrepreneur, you can always smell another entrepreneur's bullshit. And so we think that by ranking,
the judgment, right? The entrepreneur who's actually in the trenches now, who knows the market trends intimately, who knows where the ecosystem is going, has a very proximate, close view of what the traits are in a company and in a founder that could predict success versus a professional investor who has a lot of other financial obligations and incentives that are very different from what a founder does. That gives a unique vantage point to the founder. So we want to leverage this expertise, this knowledge, this ability of a great founder to pick other great founders and leverage that into creation of these pools. I mean, we could take the easy route and say, you know what, we have this great guy who used to work at Sequoia Capital and he's going to be the guy who constructs pools, but that's not going to scale. And we don't want to go that route. We took the harder route that scales, but it also actually leverages people. And when you think about it, you don't want to be in a pool with people, random people that someone else picked, right? It's good to have that screening. It's good to have that quality control, but you also, this is a community, right? You want to be in with people who actually can be helpful to you and can use your help, along with the financial diversification and high quality. So that's the reason for peer selection process.
That's awesome. Like I said, I think you guys have put together something that is filling a need in the marketplace, and I'm shocked that nobody's done this before.
Yeah, I mean, the first 3 months of my research was like, okay, why didn't anyone do this? Why isn't this done? This is such an obvious thing. Pooling risk, I mean, it's a little different, yeah, sure, but we do this in insurance, we do this in all sorts of other endeavors in life. Why hasn't anyone done this? And it turns out a lot of people have talked about it, and every single entity or institution or VC or anyone publicly in the position to be actually able to do this had a good reason not to do it. And we found out none of those reasons apply to us as a company. And then once you break that down that way, there is no physics constraint that prevents you from doing this. At the end, we know that people do want it if it works as promised. And so our job is to actually make it work as promised. Right? Like 90% of a startup is actually finding the problem that is worth solving. And so that's what gave us the confidence in the last several months that, yeah,
well, I'd say
put a lot of time and effort into solving it.
I'd say 90% of a startup is executing, 10% is finding the problem.
that's true too. But before you get onto the execution, you're still going to have this issue where, because everything looks like an important thing when you start, right? Hey, what do you focus on? Do you focus on product? Do you focus on distribution? Do you focus on marketing? Do you actually focus on something else? Do you focus on this unimportant niche that only, trivial feature that only a niche wants, but they really, really do want it? So there's all of these questions, there's all of these uncertainty, there's all of these decision trees that you go through. We don't know that we nailed it yet, but I think we are on the right path because a lot of people seem to be interested in this. They want this. And when you question it deep down, they instinctively get it. The most realistic founders are also the most optimistic, which is a very paradoxical and kind of like a quantum mechanistic way of saying this, right? When you ask a typical VC, they're all going to parrot out this exact same cliche. Oh, founders are rationally optimistic. They are the ones that actually throw away their life for this thing. They don't care about the whatever the outcome is. But when you talk to these successful founders who've raised multiple rounds of money, who've been through the startup land a couple of times, you find that, yes, they're very optimistic in what they're doing, but they're also brutally realistic. And they do this at the same time. Simultaneously, they hold these both things in their mind. So they know their odds of success. They know their odds of failure. They have a high drive to succeed. And they can see why their startup will succeed when everyone else thinks that they won't. So it's kind of the interesting pattern that we observed.
Well, listen, let's circle back up after you guys have had some traction. I think this story is just awesome. I think what you guys are doing is going to be epic.
Sure, thanks.
Thank you.
And there actually is traction right
loop.
now. What's kind of fascinating is we've collected applications from companies that have raised over $1 billion in aggregate.
Wow.
And that's just from July onward. So we had a Hacker News post.
It isn't just for early stage companies or pre-seed companies. Yeah. Our initial thought was that we're going to get a lot of pre-seed companies and we're going to have to do a lot of vetting and screening. And it turns out that we had a lot of companies that are like post-B, post-C, I mean, pre-IPO even. It's crazy. How many people instinctively get it? The founders.
Well, guys, I got another call in about 3 minutes. I got to jump on.
Awesome. Hey, great talking to you, Chris.
George, great project.
Thank you for your time.
Cool. The links are below. I hope everyone checks you guys out. I think what you guys are doing is epic. It is going to be.
I had fun. Thank you very much, Chris. This is great.
We'll do this again soon.
Okay.
Thank you. Good luck.
Bye-bye.